Hi, everyone. How are you all? Good to see. I was just walking by and I said, good to see audience of more than one. Uh, no pressure. This is a last minute thing, although Travis did tell me a week back. Uh, but so today's topic is investor clients and investing yourself. First, let's start with introductions. I am Deepak Arora. I have been an agent for about a year and a quarter with Keller Williams Santa Clara Valley, and an agent anyways for a year and a quarter total. Having lots of fun with real estate. I started as an investor about, I would say, 4 to 5 years back. That's because I could not start as an agent because of my immigration status in this country. So investing is still considered passive, which I could still do on work visa. So that's how I started there. But that confirmed my love for real estate. And I was sure I was just waiting to get my green card so I could get my license and work as a realtor. How that helped me is not just acquire investment properties myself, but almost 40% of my target clientele right now is investors. It's just happening because the kind of videos I'm posting on social media, no matter what I talk about, I end up talking about investment and numbers because now been doing it for 4 or 5 years, it's coming naturally to me. And I find it as an edge, especially in this market, because buying, so as a new agent, I primarily have more buyers than sellers. But investors do not necessarily look in those areas where the primary home buyers do. They're looking a little bit outside. And as we all know, the moment we start going a little bit outside the Bay Area, the market starts cooling off a little. So I have had, like, my strike rate is much better with investors than the primary home buyers in this market. So, and that's something I never planned for, but it worked out. So I thought, why not give a class on how to have that discussion with your investor clients? Because even more so, especially as a new agent, we may not everybody comes with an investment background. But if you focus on investor clients, that can set you apart from, I would say, almost like 95% of the new agents. So that's the reason I thought of this topic, and this is topics on which this is something on which I do not have to prepare a lot. So I thought I'll just give a class on this one. I do not have a set agenda on this, rather than just sharing my everyday practices as an investor and as a realtor who helps investors. So yeah, we'll just talk about a few of those things, few of the tools that you could use in everyday life to help your investor clients, and we'll have some fun. So can we start with a quick round of introduction, please? We'll start from all the way back with Sarah.
Introduce name and whatever.
Whatever you want to say about yourself.
Okay, my name is Sarah. I just joined the office in February this year. I'm in Santa Clara office. Yeah. What else do you want to know?
That's all.
Hi, I'm Michaela Russo. You probably see my name in emails and various posts. So I'm based out of the Cupertino office. I've been there since the beginning of COVID. That was when I made the changeover. So, I also work with a lot of investors. I started in the investor rehab world prior to my license. So you I probably have very similar approaches and mindsets as far as how we approach them.
You may be surprised. Similar but different.
Yeah, similar and different.
Hi, I'm Jeanette. I started working like maybe a month ago, or a little over a month. I am based out in the Cupertino office, and yeah, I want to learn about Valerie Walker at the Cupertino office in January.
Jeffrey Chu signed up today. Had my exam last week.
Wow, congratulations.
Guessing that
Oh, I didn't guess even single one of them. That's all of us here in the room.
Nice, and looking forward to working with you all. Came out here from Nebraska 3 years ago, and
Oh, wow.
started back into the business.
What made you get a real estate license?
I need some more money.
Exactly. All of us do, right?
Not afford anything here. It's expensive.
Welcome to the club.
Exactly.
I'm Hillary Ian. I joined our office back in October last year. I am from the Santa Clara office. Yeah, hi everyone. I'm Juliana. I'm the Santa Clara officer. I was in the floor this year. And I want to learn how to invest with them.
No. My name is Ihan Shin. I joined the Cupertino office last week.
Another brand new.
Yeah.
But he's not brand new to the real estate world. Could you tell how?
Oh, I worked at the Bank of America, Home Depot, and the PNC Bank since 2016.
So all the lender questions, ask Ihan first before you ask lenders. He will give you the unbiased opinion.
Using a presentation.
Right? That is the insider secrets of lending world.
Yes.
Hi, I am Ruby Malhotra. I got my license last year in July, so it's been 1 year, but I am still new because I'm still looking for a deal and yeah, and I would love to be an investor one day, so that's why I'm here.
I'm Priyanka Agarwal, fairly new. I had my license back in 2016-15, and then I, left after 6 months, but empty nester now, so back in the business. And I'm in the Cupertino office. I'm here to learn.
Hi everyone, I am Gagan B and I started this February. And I'm from Cupertino office.
Hi, everyone. My name is Marna Tin, and I joined Keller Williams like 6 years before, so part-time. Finally joined full-time, end of 2019, about 3.5 years. And I'm here out of the Santa Clara office, and I live in San Francisco.
Whoa.
Mirna does, yeah. Mirna does a lot of business there. Anytime you have a San Francisco referral,
Or you have any questions, call me. I'm happy to help with them.
without referral as well.
Yeah.
Just kidding. Okay, let's get started. As I said, I do not have a set agenda for this. I just noted down some bullet points and I have some resources I want to share with you all. But let's make it interactive. Feel free to ask any questions at any time. So when somebody talks to you about investment, why do you think they want to invest? Like, what is the motivation behind investing?
Building wealth.
Okay. Building wealth. Anything else? Passive income. Those are the two most important ones. Anything else? This third one, which is very frequently the reason for investing in, especially in Bay Area. Yes, tax savings, capital gains tax. So people here, so a lot of our population is in high tech. In high tech, salary is one part of the compensation, unlike the rest of the world, or even unlike the rest of the United States. The compensation package overall is different, and that's because of the stocks that people get. And with the stocks comes capital gains tax. And investment provides very good strategies to defer those capital gains as well, as long as it's invested properly or in an investment that gives you that deferral advantage. So that's one of the reasons people, even if they don't want to, they are sometimes forced to invest because they want to save those tax dollars via legal means. And then how about the goals? What do you think their goals are when it comes to investing?
Property is able to pay for itself.
Yeah, that's appreciation.
Pass on to the next generation.
Mhm. 1 second. I think somebody's trying to get here and they may not have the key. Okay. So, as long as motivation goes, yes, those are the three main reasons. Passive income, building wealth, or building generational wealth, and then tax saving. Goals, somebody likes appreciation. Appreciation is the equity gain in your property. Somebody likes cash flow and cash. We can equate appreciation to wealth. and cash flow to passive income. And different people have different priorities. Somebody bets more on appreciation, somebody bets more on cash flow, somebody bets on a combination of two. And then you also have to weigh what is their risk tolerance, especially for people who are banking on appreciation, like flippers. They are adding equity, they are actually forcing equity. What if the market goes down south? Let's say if they expect the project to be 6 months long, but if the market tumbles in the next 6 months, what is their risk tolerance? Can they hold that property long enough so that they still end up selling it for a profit, or they are able to weather that downturn by holding it? Why? Because most flippers, they are taking hard money loan or private money, which comes at a much higher interest rate than a conventional mortgage. So not all flippers are able to hold long term. So we also have to analyze what's their risk tolerance. Now, there are various strategies and we'll go over them one by one, but I won't be going into detail on anything. This is more of an overview, so you can hold that conversation. If you want to dig deeper into any particular strategy, I may not necessarily be the expert, but I could guide you. You also have to see what's the cash available with them and what's their down payment and what kind of strategy they are looking for, whether they're looking to flip, in which case they're looking to buy like a land or a distressed home or a rundown home, or they're looking for expansion, or they're looking for a rental. And within the rentals, we have three kinds. We have a short-term rental, which is like an Airbnb, VRBO and stuff. We have mid-term rental, like traveling nurses and stuff. And then we have traditional long-term rental, where you sign like an at least 12 months of lease and then give it to a tenant. Assuming somebody is looking to do like a short-term or mid-term or long-term rental, and that let's say they have 1 million cash available, what would you suggest them? Like what kind of investment they should go for, or what is, let's say, what's the price range of a property they should go for? Any ideas? No answer is wrong answer.
They have $1 million cash flow.
Sorry?
They have $1 million?
No, they have $1 million sitting in the bank, and they say, they just come to you and say, I want to invest in real estate. Guide me.
Buy you $1 million.
Okay, so that means paying all cash.
Maybe not good.
Okay, what do you think would be good?
Multiple units.
Multiple units? You mean multifamily property?
Not like a duplex or,
Right. Why do you think so?
because if you're trying to invest money, you're trying to make money out of your investment.
Right.
Well, I feel like more money there's more possibility of making more money with multiple units.
Why do you think so?
Because you can rent them out and have double the cash flow coming in rather than
Yeah.
renting a single family.
Yeah, I agree. So that's another topic I wanted to touch base on, but typically, if you take a single family worth $1 million versus a multifamily worth $1 million, that multifamily property is going to generate you more rent. However, that multifamily property might not appreciate as much as the single family. Single family, I always say it is the most sought after tangible asset in the United States. Everybody's looking to buy single family. First time home buyer, anybody who's looking to move up, anybody who's looking to downsize, anybody who's looking to retire, anybody who's looking to buy a vacation home, anybody who's looking to invest, they are all looking to buy single family. Whereas who's looking for multifamily units?
Sure.
Only the investors.
Investors.
Only investors, right? All the others are not looking for it. Well, in certain cases, people do look for, like, they are looking for a home for themselves, but they still do multifamily because they live in one unit and rent the others. And it's a cool term that has been coined for that thing, and it's called house hacking. So you live in one unit and you rent the others, and you have all others paying your mortgage, and you might still cash flow positive if there are many units in that property. Okay, what else? Anybody else has any other idea?
They can invest in different markets like 500K or depending on, different states, so that, different properties can appreciate, like one, they can invest in a multi-family in one state where it can generate a lot of income, and they can also invest for a single family house in
Mhm.
other states, so that, that will appreciate in value. So
Right.
it's a mix of both.
So basically not putting all your eggs in one basket. So don't invest $1 million in Austin, what if the Austin market tanks tomorrow? So
I think you definitely have to leverage that, right? Borrow 3 times of that, so that you can buy $3 million, $4 million houses there. And then, but it's the question about buying in the area because of the cost and return, as you just mentioned, elsewhere probably returns are better. What do you think?
it totally depends on case by case basis, but yes, definitely 100% leverage the money. Don't just, if they have $1 million, don't just have them put all cash down 100% in one property. If they want to invest $1 million, they can actually borrow four more million, or at least,
They should
For-
go for it.
they should talk to a lender. Well, talk to a lender means borrowing money, right? Yeah, so that's what, they should talk to a lender. Sarah, you wanted to say something?
No,
Oh,
I
you
mean,
forgot?
just the same, I mean, like, I would leverage the money instead of buy one, I'll buy, if my loan could qualify to buy 2 or 3, like each home would like 1 million.
Right.
I would buy 3 homes. And I'll pay my like 30% of each home and then rent it out and just let it there for like 10, 20 years for it to appreciate.
Right.
That's what I'm gonna do.
Okay, awesome. Yeah, so I agree with most of you. Leverage is a powerful tool through which most people become multimillionaires in real estate. If it wasn't for leverage, and because they say most of the millionaires in this world are made through real estate, or most of the millionaires have been able to increase their wealth exponentially through real estate. That's all because of leverage. We talk about stocks in Bay Area, like the tech stocks, they grow up so rapidly, right? They say within 5 years, the stocks double, like some of the stocks give you 20% year-over-year appreciation, some even faster, right? But how much percent does your primary home need to appreciate by to give you double your return? If you have done 20% down.
You ask a question.
Can you repeat that again?
If you did 20% down towards buying your primary home, for you to double your investment, how much does your house need to appreciate by?
100%.
20%. That's it.
That's a
20%.
tricky question. It looks like a test question.
Right, sorry.
It needs the answer.
It's-
a tricky question.
Yeah, the way I put it, maybe tricky. Yeah, that's my English, sorry.
I was like, it's a test question.
No, it's not a test question. It's a question I always put in front of my investor clients. So for a stock, for you to gain 100K, you need to invest 100K. In a property, right? So that's when you realize 100K gain. In a property, you only need for you to double your investment. So I'm sorry, I take a step back. In a stock, to gain 100K, you need to invest 100K, which means 100% gain. So your value doubled. But in a house, if you put 100K, which most likely means you bought a house worth 500K. For that 500K home in Bay Area to go to 600K doesn't take much time. But the moment it goes to 600K, your initial investment was only 100. That gain is all yours. To the bank, you're only giving that interest, right? No matter how much your appreciation is. In the year 2020 and 2021, houses appreciated like 20% year over year. We were still giving 2.5% interest to the bank. So that's the power of leverage. Like there were people who doubled their money in real estate in just 1 year, in 2020 and in 2021. How often do you see that happening in the stocks? There's another benefit. When you sell that home, there are strategies to save taxes. More than one strategies. There are not so many strategies available when you have capital gains tax in stocks. I always say, let's not record this. US laws are pro real estate because the people who are making these laws probably own tons of real estate. So always try to own real estate, whether you are buying for yourself or investing. So this is what I recommend if somebody has $1 million sitting in the bank. I suggest, and if they are starting investing, I suggest let's not use up all of your money up at once. Maybe let's take 200K out of it. And it's just an example. Your numbers can vary. We will take it as a pilot project because you're starting in the investment world. We will take this 200 and then decide, or it could be 100, depending on which area you're doing investing in. Let's take this 200K and we will invest in maybe a single family home or a small multifamily like a duplex, triplex, fourplex. Because with this, you're going to learn how to be an investor, how to be a landlord, how to deal with your tenants, how to file your taxes for investment property. And if you're hiring a property manager, how to manage the property manager as well. And then if you like overall process, if you like what you got yourself into, then we can invest more money later. Like I'm not looking at every time I help a client, whether it's an investor client or a primary home buyer or seller, I am not looking at how much commission I can make at that point. I'm looking at how much business I can get for my entire real estate career. Because if I do a good job for them, not only they will come back to me, now their sphere kind of becomes my sphere. They're going to spread the word for me because I'm going to exhaust my sphere one day. But if I have these, what you call as cheerleaders, who are cheerleading for me in their sphere, my sphere is growing exponentially. Something we were just talking about earlier today, right? So you want to give them the right advice, whether they are buying the primary home or whether they're buying an investment. Either case, if you do a good job, they come back to you and they bring more people back to you. So I try. I usually tell them, let's do this year, and then if you like it, then we can invest more money next year. By the time you'll be experienced, if you want me to use the entire remaining 800K, I'll use it. But sometimes people just say, I have 50K, I want to get started in investing. What should I do? Then I tell them, like, go find a partner. Again, it depends where they are trying to invest. They could be trying to invest far away where 50K is enough. So you use our KW referral network and you refer them to a top agent there. So just one of those, right? But I totally agree, leveraging the money, not just putting 100% cash down, but using that money and leveraging the bank's money. You also have to see what's the risk tolerance, not the risk tolerance, but what their cash flow tolerance is, because doing a 25% down and then 75% loan might not cash flow for them month over month. They may have a negative cash flow. So they need to be okay with it. If they are not okay with it, you want to go like a 30 or a 40% down. And it's a decision for them to make. Would they rather buy 2 or 3 properties with that $1 million or 5 properties with that $1 million, but be ready to have a negative cash flow? It all depends on their tolerance.
I have a question.
Yes.
For example, if they have $1 million already in their account, and if I ask them to start with 200K, as a down payment and, leverage the rest of the amount,
Mhm.
they'll be like, why would I pay back for the money which I already have? So would it still make sense to ask them to leverage or that 200K, or just use it as a full cash, cash payment for the property?
So you're saying why should they have a negative cash flow
No.
when they already have money in the bank?
Yeah, exactly.
Okay.
Because they already have, and why would they be paying, 7% to the lender for the loan?
Mhm.
Because they already have money in their bank.
Right. So that's what I just touched base upon. Like, would they rather buy 2 or 3 properties, or would they buy 5 properties with that $1 million? You have to see what their tolerance is. Personally, my strategy is if I can almost break even, or let's say I'm getting $100, $200, $300 negative cash flow, I would try to buy as many houses as I can.
Right.
Cash flow is not something that's going to make you rich over time. Cash flow is for sustainability, so that you can sustain the ups and downs of the market.
Yeah.
Appreciation is what's going to build you wealth. I would rather invest in more homes that'll give me more appreciation than all my money in one home, because it's going to appreciate for what it's going to appreciate.
Mhm.
Imagine let's take the example again, 2020, 2021 were anomaly years, but on an average, Bay Area market appreciates 6 to 7% year over year. If you see the last 30, 40 years, right? So if you invested that 1,200,000 each in 5 different properties and they are appreciating 6% year over year, how much more you are making, right? Rather than just one property. If you compare it to the negative cash flow, it's a very, very, very small amount compared to the 6% appreciation. If it's a $500 negative cash flow, that's $6,000 per year. If it's a 6% gain on $1 million property, 60,000. So we're looking 60,000 versus 6,000. So as long as that negative cash flow is not hurting them, they should go ahead and leverage as much as they can. If I go in the numbers, it might become very complex and boring, and I don't want to do it today, but this is just like at the bird's eye view. If they are okay with the negative cash flow they see today, they should try to leverage as much as they can. And remember this, an equation that almost breaks even today will break even tomorrow, will cash flow positive the day after tomorrow. Why? Your mortgage is not going to increase. Your rents will pretty much always increase. Your property value will pretty much always increase. Another benefit, if your property value increases substantially, you could do a cash out refinance and take out all your initial investment capital. So once you do, just in general, what I have seen with my investments, I try to put 25%, no more than 25%. But if my investment increases by somewhere between 30 to 40% appreciation, I do a cash out refinance and get all my initial 25% out, and the property is still rented. Okay, it may cash flow negative after I do a cash out refinance because the mortgage went up. Everybody understands what a cash out refinance is, right? Okay, mortgage went up because I took a bigger loan, but the house is now free for me, right? If I bought a 400K home, put 25% down, which is 100K, right? Let's say the home became 600K now. Bank said would lend me 75% of the appraised value. If the home is now 600K, I can take out 150, which is 25% of it. Now I put in 100K initially. I took out 150. So the home gave me 50,000 back. But my mortgage went from initial 300K loan to now a 450K loan. So if it is now cash flowing negative, I am okay because one, I got that 50,000 in the bank, and second is somebody else is paying my mortgage. One day the house will be free for me. I have no money left in there. That 150, which I got from this house, I can use it to buy another house, and that will appreciate. Somebody else will pay its mortgage. I will get the tax benefits for it.
How would you handle the people that says, okay, when you initially take a loan, the interest is 2.5. When you do refinance, cash out refinance, 6.0. Would you still do that?
Depends if I can, if my cash flow tolerance is that much.
Oh.
Yeah. So you run the numbers, you say, maybe you don't want to take out all the 150, take out 50K.
Okay.
So your mortgage would only go up by a little.
Okay.
So you could take out whatever is comfortable to you.
Okay.
Because if the 400K home became 600K, it did not become overnight. It probably became 600K in 3-4 years. So your rent also kept going up in those 3-4 years. The cash flow kept getting better and better and better. Now, if you want to take 50K out all at once, but your cash flow is 0, that may be okay for you, right? I have one such property. I bought in Antioch in the year 2019, December, did a quick renovation in January, rented it 2 weeks before the pandemic. Lucky.
Yeah.
Very nice family with 3 little girls. They stayed throughout the pandemic, 2 years, never missed any payment. After the pandemic got over, they left. Couldn't be a better scenario, but I overcame a lot of hurdles initially. And that's a story for a later time. It was to a point that it got me very demotivated, and I was actually scared to venture into real estate investment. But thankfully I overcame those hurdles. But then after that, it worked out well. The house shot up during 2020 and 2021 in value. I did a cash out refinance. I got 25,000 more than what I had put in. And the rents came up 30% at that time. So as of today, I have 25,000 back to me and the house is still cash flowing positive. So this is actually a real example and I could show you guys if you want that home.
I have a question. So when, for example, when the house go up to 600 and you take out 50K, right? So for example, the first mortgage is 2.5%. Now you take out the 50K and the mortgage currently, let's say 6%. So the total, how do they calculate it?
So that when you do a cash out refinance, your entire loan gets moved to the current interest rate. The other thing, so if you do a cash out refinance, it's a new loan. You pay out the previous loan and you get a new loan at the existing market interest rate. However, you could do another thing called as HELOC, home equity line of credit. They're very strict when you do a HELOC on an investment property. But if you want to do just the HELOC for the equity that you have built up, that is another option. Okay, so HELOC is like a credit card. They issue you a credit card on the extra equity that you have gained in that home. The good part is you will only pay mortgage on the amount you take out of the HELOC, that line of credit. And then as you keep paying it, your mortgage will keep fluctuating. Like for our home, primary home, let's say today I put 50,000 more towards my mortgage, towards my principal, sorry. My mortgage amount month over month is going to remain the same. I'll just pay it off early rather than 30 years. But my mortgage month over month today is going to remain the same. It's not the case with HELOC. If you borrowed 100K from your home equity line of credit, someday you decide to pay 20K off, your payment would change the very next billing cycle. So that's if you want to keep that 2.5%, just get the HELOC on the equity that you have gained, because that's what it's called, home equity line of credit.
Which means that you can only take 200 maximum out.
It may even be less. They give overall 75% of today's value. So let's say you had a standing loan of 300 on the property and the property value is 600. 75% of 600 is 450. So your HELOC might only be 150 because you already have a 300K loan.
This is for investment property.
This for investment. Home actually,
Primary ownership is a little different, right? Is
primary ownership is different. But I think today even for primary home, they give HELOC only till 75%. Pretty restrictive on HELOC these days. Ihan, you have something to add here? He's like, I do this all the time.
You are rich, you can get.
If you are rich,
You can get
okay,
it.
right. High net worth.
So you think
I was talking about me, I'm
the
poor.
HELOC is better than the refinancing, right?
Case by case. If you don't want to use, if you don't want to leave that 2.5 or 3%, I actually never got 2.5, 3% on my investments. The best I got was like 4% because investment is always like a percent higher, right?
Yeah.
So if you really need that cash, you do your numbers. If you do a complete cash out refinance, what would be your mortgage month over month versus what would be your current mortgage plus the HELOC mortgage amount? What's higher? Another thing that most people ignore here is how much are you paying towards the principal? And I'm going to get into it to show you how to break it down. That's another discussion to have with your investor clients when they say, oh, I don't want any cash flow. I don't want any negative cash flow.
What if your house is paid off?
HELOC. Yeah. You either sell it or you take a HELOC.
Take that.
But these days, HELOC are going at 8.5%. So you might want to be careful using it. It's even 1% higher than getting a loan for an investment property. So I have a HELOC on my primary home. I've never used it. I needed money one time to buy investment property. I took a loan out of my 401k and my wife's 401k, and I told her later, and I got beaten up for that. But I just didn't want to use my HELOC because it was so high. A 401k is basically you pay an interest, but you pay it back to yourself. So you're not losing anything. Yeah, and especially when I took it out when the market was down. So you take out the money and when it's going up, you invest. So it works out even better. I'm sorry? No, you don't pay a penalty. You pay an interest. It's a loan. It's a loan. Yeah, it's a 401k loan. No, I did not break the, yeah, I did not break the fund. I kept it, but you can take a maximum of 50k or like half of it, whichever is lower.
Could you
Yeah.
like do monthly payments on it? or-
You do a monthly payment on it. Sometimes when you have a W-2 job, they would just deduct out of your paycheck. But if you do not have a W-2 job, then you connect a checking account to your 401k loan and it just deducts every month. Yeah.
So if you take out a loan from 401k, which means you have to pay 2 mortgage, right? Because you're not gonna take the thing out to pay cash on the house, right?
Yeah, it is a loan.
So which means like if you take 401k, check for example, for down payment 20%. So you have to pay back the loan for 401k and the loan for the new house.
Of course, for that matter, you also have to pay your HELOC payments, right?
Okay.
So it adds to your liability, no matter what. Yeah. So you have to run it by your lender and let them know, hey, I'm pulling money out of HELOC to make up the down payment. Or hey, I'm pulling money out of my 401k loan. Don't hide anything from your lender.
Yeah.
Whatever. Yeah. Okay. Next thing I want to talk about is the buy box. There's a Bay Area investor. His name is Michael Zuber. He has a very famous book called One Rental at a Time. I really liked reading his book. I recently attended one of his meetups as well. He talks about this term called buy box. Buy box is basically defining your buying criteria very, very, very well. Like which area, or not just which city, which area and which city, which neighborhood, what kind of property, single family, multifamily, condos, townhomes, location specifics, whether you want it in a cul-de-sac or whether you're okay with getting a house near a busy street, on a T intersection, corner lot, it could be whatever. What are you looking for? Are you looking for short term? Are you looking for mid-term? Are you looking for long-term rentals? Just define it so well and analyze properties that fit your buy box every single day. Why? Because if there's a property on market that you like, there's a high probability many other people like as well. So if you have your buy box defined very well, you can make a very quick decision. Because as an investor, it's a little bit of a nervy decision, right? To make, I mean, buying a house in Bay Area itself is a is a big step. And then on top of that, we are talking to these people to make investment in real estate. It's not easy, but if we help them define their buy box very well, it doesn't happen overnight. But once they analyze enough properties within their buy box, they are much more confident of putting an offer like almost instantaneously. So they should do it and you should do it. Why you should do it? I have my buy box. So I practice it pretty much every day. Like I have all those search agents set where I'm looking, what kind of properties. So I spend 20 minutes, half hour, pretty much every single day on it. If an investor comes to me totally clueless, guess where I am pointing them to? Yeah. My buy box, because I practice it every day. And I can share everything that they won't even get from most of the agents here. So define your buy box, practice it, even if you don't have investor clients. So when it's like listing presentation, right? Just practicing it, so that you don't start creating your listing presentation once you have a prospective seller. You are ready with it. You just plug in the numbers and you're ready to go. Sorry?
What is the book name?
One Rental at a Time. He started investing in Fresno and he started with one rental at a time, but then he went into multifamily. It's a good book. I can refer a lot of books to you. I was not a book reader. I only read my course books in school, that too like a couple of days before the exams. But for some reason during the pandemic, I got so hooked up to the real estate books. As an investor, I ended up reading quite a few of them. So if you need some pointers, I can help you. I can help point you to some of the ones which are in layman's language that you could understand. Like I pretty much listened to all of them. I never read. I just cannot sit in one place and read a book. I have listened to them and I have got so much just by listening listening to them. If you are somebody who likes to sit and read, you will get even more out of them, because sometimes they talk about numbers. Sometimes they ask you to visualize something, which is not easy when you're driving the car on 237. So you'll get even more out of them. And I have some books that I just bought that, okay, I listened to it. I found so much value. I think I can get more out of it. Let me buy it. I've bought those books and I've kept with me, but I've never read them. I may be able to provide you those books, but don't be like my middle school buddies who take the book in one condition, but give it back in a different condition altogether. Because these are brand new books that I bought. Okay, so also always ask open-ended questions. Whether it's your buyer, your seller, your investor, anybody, do not ask a yes or no. Always ask open-ended questions. Ask them if they need your help just to buy one particular property, or they're looking for more. Are they looking at, how many know what a 1031 exchange is? Okay, some, right? 1031 exchange is basically deferring the capital gains tax on the equity that you have gained in an investment property. So just like we were talking about, your 400K property became 600K. Now, if you sell it within the first 2 years, there's a 25% tax. If you sell it after 2 years, there's a 15% tax. Actually, no, it's actually taxed at your tax bracket. Right? It's at your tax bracket. So you could be in 25, 35, 48% tax bracket. So to save taxes on the equity you gained in an investment property, government provides you what is called as a 1031 exchange, which means after the sale of that property, you have 45 days to identify a like-kind property in which you can invest the proceeds. Now, this does not mean you bought a property at 400, you sold it at 450, your cost of selling was 60K, but you still got your down payment back and you're trying to save taxes on it. No, your cost was 460, you sold it for 450, that's a 10K loss. What you got back was probably your down payment. That's not a gain, that's a recovery. So you do not need to invest it to save taxes. Okay, I'm in recovery situation right now on one of my properties. So I don't need to invest that cash unless I want to.
But that's only for investment property, not for your property.
Not for your primary. Primary, there are other ways.
Okay.
Different topic. But it's tough. Okay, so 1031 is basically for saving the taxes that you owe on the equity you gain in an investment property.
So 1031 is never for primary?
Never for primary. Have you done that?
No.
Okay. Thank God.
No, I'm just asking.
You know, it is for investments. But the term like kind is very flexible. I've seen people invest, selling a single family and investing in a strip mall. How is that like kind? But it's very vague. Right. Yeah. Your CPAs should be able to help you with that.
So in order for them to claim that as an investment property, you have to show the income prior years
Or loss.
or loss.
Yeah.
If they never did it, then they cannot claim it only at selling.
Correct. So now it's a question whether you want to save taxes on that or you want to utilize the 250K or 500K tax advantage on a primary home ownership. Right? You can only do either 1031 exchange or claim the tax credit on that. We all know that primary home equity of 250K filing single versus or 500K married filing jointly, it's no tax, right? So is that more beneficial or doing a 1031 exchange? I think this is more beneficial unless you have like a 2 million equity. You bought something for 3 million and you sold it for 5 million. Maybe you want to do 1031 exchange, but then make sure it is qualified as an investment property. How does it qualify as an investment property? Out of the last 5 years, you should have stayed there for less than 2 years for it to qualify as an investment, and for at least 2 years for it to qualify as a primary. Yeah. So one of my yes.
Talk about taxes. So example, if you buy single family house,
about over like 2.5 million. So every year you need to pay property tax, right? So property tax you can do anything, only under $10,000. It has to be qualified.
Right, that's for
So
primary.
You need to pay.
Yeah.
It's expensive.
It is expensive. Yeah, primary home ownership, it's expensive, but it comes with a tax advantage, which is huge.
Yeah.
Assume 500K of equity. If you are, if you're taxed at 30%, that's 150K.
Yeah, so.
That's like one person's income.
So people
Bay Area.
buy 3 million houses, every year pay property taxes.
Yeah.
A lot of money.
Yeah.
How do you think?
I also have the same question, but apparently those properties are overbidden in Bay Area. So they have even more money. Bye, Tina. So yeah, same question. But yeah, people don't care. They have money. And also I've noticed that's a totally different market altogether. I'm actually helping a buyer right now who's looking in that 3.54 million range. The moment we start, okay, let me take a step back. When we're looking for, let's say like a first-time home buyer or even a move-up buyer in $1 million to $1.5 million range, people are somehow trying hard to make this 20%, 25% work. The moment you get into 3 million plus range, most buyers are doing 40, 50% down because you're starting to get into luxury market. It's not a necessity, right? This is what they don't need, they want, right? $10 million homes, they're mostly pay 10, 15, $20 million homes. The homes that celebrity buy, they pretty much always pay cash. And they're not just buying one home, right? So that's a different market altogether. So if they can pay 50% down on a 4 million home, they can for sure pay the property tax, right? So it's a different market. We'll get there someday, Julia. We'll be doing those deals. And then we'll talk about this.
California has lower property taxes than some other states, right? So.
It's one of the lowest.
It's one of the lowest.
So
It's all relative.
Yeah.
You know, I'm originally from Illinois. My parents still have their original house. It's now a rental. If they were to sell it, they maybe get 230,000. They've owned it for 40 years and they pay $7,500 a year in property taxes.
New
And it goes up
Jersey,
every year.
yeah.
Yes.
Yeah. I heard New Jersey has one of the highest. It's like 7 or 8%.
Yeah.
Imagine 7 or 8% tax here.
I tell you, because this is my problem. My husband, I want to buy a house. My husband, every year pay property taxes. So much money. What
Tell
you
him.
can buy, right? Even 3 million, 4 million, we can buy. But every year you pay property taxes. I don't know how to deal with it.
Okay, yeah. Right.
It's
How about I
different.
help-
It's very
How about I
different.
help you buy and I'll give you 1.5% commission back. That'll help you cover the property tax for a few years.
Property taxes is probably really interesting. What's the prop 13?
They can carry 55 and over, right? Yeah, so you can carry over your property tax from your current home to a newer home. It's for people who are 55 and over. Yeah, so that's,
Still more money, still more tax. Even if the
yeah,
property.
you
is
have like,
It's much higher in value.
yes, yes.
It's an incentive to get the older population that have been here for decades.
To leave,
That
yeah,
have properties free and clear to move and
To
open
move.
more inventory.
Yeah.
So they have all these various incentives.
right.
To.
Yeah, because what's happening in certain, yeah, because what's happening in certain cities, they do not have enough students in elementary and middle schools because the older population is not moving. Think about Saratoga. They do not have enough students in elementary schools.
Right.
So expensive, Saratoga, not everybody. can
Expensive,
afford
yeah.
it.
And also, how much is the inventory there? Even if people can afford, right? It's just the house gets overbidden and sold very quickly. That's just one example. Okay, coming back to this, going back to your question, Michelle, right? Sorry, I forgot you. Hillary, sorry, Hillary. I had a brain fart, sorry. Going back to your question about saving taxes on a primary home, that's beyond, let's say 500K. You can invest in the money in what is called as an opportunity zone. I think I'm not a tax advisor or a CPA, disclaimer. But opportunity zones are like identified by government. It's like, I think they have certain criteria where they say like within one square mile of this area, if the employment rate is below certain percentage, it is qualified as an opportunity zone. So government promotes that zone or that area to bring in employment, bring in business. So if you invest your capital in opportunity zone, your capital is tax deferred.
Yeah, hard and very very hard to find that in.
You will be surprised. I showed a property 2 days back. It's a multifamily. They are building like these days that Santana Row kind of concept is very popular, like retail at the bottom and condos on the top. Fremont downtown. How many of you know there is a downtown in Fremont? I didn't know.
It's up and coming.
Yeah, I took a picture. It says Fremont downtown. It's right on Capitol and Walnut, or Paseo Padre and Walnut, if those two intersect. Yeah, it's right there. They've already built like 3 developments there. This is 4th one, and they're my friends who actually put in the major chunk of the money, and they're looking for investors. So anytime I have somebody who doesn't have the time but has money looking to invest, and also people who are trying to defer their gains tax from stocks, I connect with them if that is something they would like to invest in. So opportunity zones, you can invest. And this is again a differentiator for you when you're talking to investor clients. And those developers, they will give you 2.5% of the amount you're bringing in. It's not the house value. Let's say somebody invests 250K through you with them. They'll give you 2.5% of the 250K. They're keeping it fair, like giving us some incentive to bring clients.
What does the client gain with a portion of that?
Yeah, so client is something called as an LP, limited partner. So imagine this, they are holding some shares and they get the appreciation when the property is sold. And until the property is sold, they will get a cash flow once the property is leased out.
Okay.
So they project.
Have a long conversation later.
Sure. Yeah, it will be a pretty long conversation. Yeah. And I can connect you with them as well.
Okay.
So they could, I mean, as a co-agent, so they could explain you, and I can share the docs with you. That's just one example, but I was surprised to see a part of Fremont downtown classified as opportunity zone, because the city is trying to build it.
Interesting.
So it's classified as an opportunity zone.
Thanks for sharing.
Yeah, no worries. And then your team is your boots on ground. Very, very, very important. Again, this is a differentiator. Especially if you have a buy box and you have a team in your buy box, you are all set. You have all you need to present to an investor. Who's your team? I always say core 4, agent, which is you, lender, contractor, and property managers. So why do you need contractor? Investment properties, more often than not, need some kind of work. So you could have a general contractor. General contractors always come at a premium because they're like project managers. So they add their cut. I like a la carte. I picked a flooring guy, a painter, an electrician, everywhere. I love an app called Thumbtack. One time I did entire rehab sitting in my home through Thumbtack. They pretty much, you can find the top contractors for any job on Thumbtack in any area. Pretty much all of them take Venmo and Zelle. And they work solely based off referrals. So they do a good job. They send you pictures. They are tech savvy because they're using that app. So I love it. And that may not be the only app, but definitely get your team, which is your boots on the ground. Go build your network, go to the real estate meetups, anything. Your buy box could be anything, any area, minus Sacramento Valley. So I pretty much aware of the Sacramento Valley, Sacramento County, Yolo County, Placer County. Those are the 3 counties that come in Sacramento Valley. And I've been going there since 2019. I do not mind driving up there, and I've done it several times. I have few properties there. I know contractors. I have property managers there. I know various agents. And depending on the deal, I touch base with 1 or 2 of them. I have currently listed one of my investment properties, but with another agent there, because I would rather spend my time doing open houses here for million, 1.5, 2 million homes than sell that 500K property. And she's the one who's doing business there. any leads that she gets would be more valuable to her than me. So it works out both ways. And then you could add more players into your team, like the real estate attorney, a CPA, a cost segregation specialist, financial planner, depending on every investor situation. As I said, every person's situation is different. So depending on that, you could connect them with either or. Did you have a question, Kevin? No. Okay, I thought you raised your hand. Sorry. Who knows what cost segregation is? Nobody. Yes. Okay, that is something we can talk about. So there's something for me to share, right? To something that you can take back from this class, rather than me showing you one page of Microsoft Word. So cost segregation is to whom it's useful. It's useful to people like us, but it's mostly useful to people who are qualified as real estate professionals. Now, real estate professional is not a certification where we can go to SCORE office for 2 days and get a certification. It's actually a tax classification. If you are classified as a real estate professional, you could take bonus depreciation on your investments. These are all keywords that you could look up the internet later. Basically, what bonus depreciation means, if you have an investment property, you will see that a house has 2 parts, land and the dwelling. Dwelling is the structure. Land does not depreciate. The structure depreciates. The structure depreciates according to US real estate laws over 27.5 years, which is 3-point-something%, almost 4% every year. So any cash flow that you get from your rental property per year is pretty much offset by this depreciation, because our structures are usually like 400, 500K, right? So let's say the structure's value is 500K. 4% of 500K is roughly 20,000. Can you find any property that will give you 20,000 of positive cash flow? Cash flow, first of all, doesn't exist in Bay Area or even like further out, all the way to Sacramento. It's pretty much like you break even, at least when you start. Even if you get cash flow, it's like $100, $200, $300. That's like $3,000, $4,000, $5,000 a year. So if your structure is depreciating by 20,000, you're actually not paying any tax on that cash flow. But even if your depreciation, I'm trying to tell in as simpler language as I can. It's usually a little more complicated, but that's a discussion to have with your CPA. That 20,000 of depreciation is considered like a loss to you, even though it's not a loss. Even though they say the structure depreciates over 27.5 years, the structure doesn't lose its value over 27.5 years. We have 70, 80, 100-year-old homes here on which we overbid, right? So that depreciation is kind of an advantage to us, a tax advantage. So that 20,000 will offset. Let's say you had a 3,000 positive cash flow. It'll offset this, but then you cannot use the remaining 17,000 to claim losses on your income. Okay. But if you're classified as a real estate professional, that entire 20,000 can be assumed as a loss and can help you offset your income. So let's say if you earned 500K and you have 5 properties showing 20,000 depreciation each, you can take that 100,000 and offset your income by 100,000. And so you will not be taxed on 500K, but only 400K. It gets even better. That 27.5 years of depreciation, you can claim in year 1. Yes. So you can claim all of that loss in year 1. So if you bought an 800K property in which the land value is 300K and the structure is 500K, I think it's going to decrease to 80% this year or next year. But as of last year, it was 100%. You can take 100% of the structure depreciation in year 1 if you're qualified as a real estate professional.
Why would you want to do that? Just for,
Why won't you want to do that?
I mean, I guess, but if you have multiple properties, I would think that you're using it all front, your depreciation.
What's the benefit of deferring it?
I don't know.
Yeah. Okay, so I'll tell you
So I
both
should ask.
scenarios.
Okay, I'm ready to hear what you say.
So if we are deferring it, we would be saving on taxes every year, right? Rather than just saving on taxes on.
Yeah, but little.
Very
But
good.
here you're actually getting more money back. Taxes. So again, if you have $2 million of depreciation across 7 different properties, the government is not going to give you 2 million because you never earned 2 million. It will only offset your income. Worst to worst, best to best, you will pay zero tax. Rest is going to carry over to next year.
Is that because, when you said because you're a real estate agent, right? Is that because it's your livelihood?
Real estate professional.
Real
Yeah.
estate professional.
So yes, so real estate professional has very specific criteria. It says 750 hours and at least 50% of all work you do in the entire year should be geared towards your real estate investments, not helping your clients as an agent, your own real estate investments. For people who are on W-2, it's difficult to qualify as a real estate professional. But for people who have their own business, it makes it very subjective. Time to talk to your CPA. Even for realtors, we realtors are business owners. Somebody who's investing may be able to justify that the 50% of their time and 750 hours in a year, they are putting towards their own investments. And if you can qualify as a real estate professional, then you save a lot on taxes upfront. The downside, when you sell the property, you will not get that tax advantage, or you will not, because you took it upfront. But if I am trying to sell a property 10 years down the line, I would rather have that money today for leverage. So I can take that money today and invest it somewhere else. So now this is also growing and that is also growing.
That's the thing is down the line, you're gonna have appreciation.
Appreciation will be there on that property. Yeah. So if I take this money out and invest it somewhere else, now this is also appreciating. That is also appreciating. I have tax advantages on both. I could do 1031 exchanges on both as well. I can leverage banks' money on both as well. So multiple layers of leverage. So that's the advantage. Now, how do you do the bonus depreciation? Bonus depreciation is the keyword. Real estate professional, bonus depreciation. How you do bonus depreciation? There is a study called cost segregation. That's the third keyword. There are specialists. These people are like engineers. You give them the address, they would send somebody out, they would do a cost segregation study on your investment property. They'll usually charge like $1,500, $2,000 per property, maybe more in Bay Area, 3,000 or something. But they will give you a cost breakup of your entire structure. I'm about to do on 2 of my properties because I may qualify as a real estate professional this year. I still have to see how a cost segregation study looks like, but they break down every single piece in your structure in terms of the cost. And that's how they give you how much you can save on taxes if you do a bonus depreciation today. If any investor wants to do it, they better rush because I think the cost segregation is going to decrease by like 10 or 20% year over year going forward, which is tough luck for us. But as of today, it's still available. And I think it's going to be 80% either in 2023 or in starting 2024. I don't remember exactly. So yeah, that is something, again, not a lot of people know. If you know that, that sets you apart. So these are some of the points talking about when holding a discussion with investor clients, because when we talk to a buyer who's planning to buy their primary home, we put up a nice presentation and we talk about emotions, we talk about any direction, the layout, the entry door, and all that stuff. Anybody else is involved in decision making, this and that. How many bedrooms you need for the house? How it's going to be for the kids? How it's going to be how it's going to be for you, the couple, the parents, and all that stuff. When we talk to investors, it's all numbers, right? Where they will get the best bang for their buck. Are they planning to do a flip? They're planning to do a rental. Which area? Cash flow, appreciation is totally different discussion altogether. As long as you can convince them on those and you can show your knowledge on all these things, they'll be impressed and they want to work with you. Talking about investing yourself, I have another page. Any observations? No, it's the same page with a different heading. Nothing is different, whether you're investing yourself or talking to investor clients. It's the same points that matter.
Can I have a question regarding 1031 exchange, because I have a client.
I'll try.
Okay. So after it applied, the rule applied even.
You have to put disclaimers, Hillary. Why are you laughing? Right? Because I'm not the 1031 exchange firm. But yeah, go ahead.
Like, is that applied, the rule apply even different stage? Okay, so after you sell the home, you have 45 days to identify a property equal or greater value.
Yeah.
What does that mean in identifying?
This is the property I'm putting the offer on, and you should have your you should write an offer and get your offer accepted.
Oh, identify means your offer have to get accepted.
I think so. That's what it means. Now, there's one thing, again, most people won't know that I'm going to tell you. It's called reverse 1031 exchange. You can sell your older property after you buy the current property. But you need to talk to the 1031 exchange firm, and it's costly. Like a regular 1031 exchange is more like $800. A reverse 1031 exchange is more like $9,000. But if you have to buy, you go and buy. Worst case, you pay $9,000, but save the tax on the entire equity gain. So it's reverse. Okay. Third thing that even lesser number of people will know. If you do end up buying a property or getting into a contract on the next property first, and you still have to sell this, if possible, talk to this seller to do such an extended escrow that you end up selling this one first. It's not about getting into contract date. It's about close of escrow date. If you get into contract on the new property first, but you close it after you close the old property, this is still a regular 1031.
Isn't there a time frame you have to close? 180 days, something like that? No.
I don't know, but I think if you do 60-day and you can do 21, 30-day on this one, most likely be okay. Yeah.
Okay.
Again, I am not the professional for that. You need to talk to 1031 exchange firm. But both of those scenarios, in addition to a traditional 1031 exchange, are doable and people do them all the time.
Can that be done on a primary too?
Again, not 1031. Yeah.
Oh, yeah, no.
Yeah, primary anyways gives you 500K free equity, right? And then on top of that, if you want to save, then put an opportunity zone. So that's pretty much it. If you have any questions, I'll take them now. Otherwise, I just wanted to show you some of the resources I use on a daily basis, analyzing properties. So, okay. All right, cool. The first one I use is Bigger Pockets. I don't use it anymore as much, and I don't like it. I don't like not using it as much. I want to use it more. But I call it the LinkedIn of real estate investing. You will find many investors, lenders, rehabbers, wholesalers, contractors, anybody and everybody related to real estate investing here. Very genuine people, very willing to help others out and build networks. You will also come to know about meetups, various kinds of real estate investing events. This is just awesome. In particular, I love any posts or topics by Brandon Turner and David Green. Those are the two main people who basically carried Bigger Pockets forward over the years, but now other people have taken over. David Green is a Keller Williams agent who's very active in, I think Sacramento Valley and Contra Costa County, Brentwood. He was a cop turned real estate agent turned real estate investor. And he he's now very big in the real estate investment world. If you listen to his talks, it's so simple, so easy to understand. He's not trying to sell you anything. He's not over expressive because he's a cop, I guess. Just talks to the point, very simple. Like I love that. I can hear him all the time. I've attended some of his meetups as well. Very, very easy to follow. I've also read his books. Brandon Turner, totally opposite, even more brilliant, I would say. Very fast speaker. Sometimes I have to go back and listen to him again, but captions help. Yeah, very sharp guy. He started broke, and he's now into big multifamilies. Like, no, sorry, he's into mobile homes. He buys like 200, 300 mobile home parks. Yeah, he's buying all over the nation as of what I remember last. Bigger Pockets has podcast, which is the most popular thing. I like YouTube channel. Yeah, they have a very active, pretty much every podcast is on YouTube channel, and YouTube channel has more stuff too. Listen in your free time, download lots of free resources. They have a free account, they have a pro account. Pro account is like $400 a year. I pretty much always sign up for pro account, even if I'm not using it. The only reason is when I approach people directly for any off-market properties, if I have a pro badge on they just take me a little seriously. So even if I can get one deal in 2 years with that pro badge, it's worth it for me. But you don't have to. That's so much available for free anyways. So if you have an inclination towards investment, go sign up. And this is something also you can tell your investor clients, hey, do you know about bigger pockets? You don't know about bigger pockets? That should be your first step. Next thing is the rental property calculator. And there are several over the internet. I like calculator.net one. Let's analyze one property. Anybody has any property in mind? Or I can look something up. Something cheap, because the more expensive it is, the worse the number's gonna look. Let's go to Redfin. I like Sacramento area, but let me know if you want me to analyze.
Good question.
Yeah.
Where can you find a rental agreement, things like that, online or?
You can find it online. Car website. Yeah.
Car
Car website. Yeah. You can find the rental agreement. Yeah. You can find it. You can add your own terms to it. I usually just go to my property manager and they do it for me. Yeah, but I have had investor clients who rent it out themselves, especially in Bay Area. Bay Area renter population is also pretty good. If you just have 1 or 2 rentals, you don't necessarily need a property manager. If you have little bit time on your hands, I invest in Sacramento, Contra Costa County, slightly different target audience. And then also it's far for me.
And how much you paying to have percentage-wise?
Different for different ones, usually 6 to 10%, or more like up to 8% in these areas. Like I found a really good one right now. I was not happy with my previous one in Sacramento, so I ported over to this one. This one is charging me 6%, which is very reasonable. The best part is we have a month-to-month contract. I was like, why are you doing this? Because I've never seen any property manager doing a month-to-month between me and the property manager, not between me and the tenant. Mm-hmm. He said, if you're not happy with my services, why would I want to work with you? I was like, that shows your confidence in your services.
You think that's because you have multiple, you have some volume with him? Is it just one property?
I just gave him one duplex, which was 2 units. Yeah, no, he said that's in their contract. He said, this is our standard contract. Yeah.
Can you try 3064 Shields Loop?
3064.
SHILES.
Shields Loop, Brentwood. I like Brentwood. I think Brentwood is primed for appreciation long term. Travis also believes the same. Travis does a lot of business in Brentwood, by the way. Okay, so this is a single family. Nice. Okay, let's do this. 709. So should we assume this is the purchase price?
Yeah.
Or you're lowballing? It's
No,
still-
and not at this market.
Okay. You never know. How many days has it been on market?
Very new.
Very new. Okay, so we're not lowballing. So 719,900. Okay, how much down? 25% or more? Investment, we're talking about investment, right? 25%?
Mhm.
Okay, interest rate. 7.
6.2. Oh, you.
You can get 6.2 on investment today? Let me know which lender.
Okay.
6.2, okay. It's investment, you may not get anything below 7, like it's like 7.5 right now. 30-year loan term, let's say closing costs.
Oh, you mean Marshall?
Marshall,
Yeah. You
Marshall,
can still get below 6-7% for investment.
Marshall is the lender.
Yeah. Recommended by Travis. Yeah.
Really?
Still
Can you
get
send me the contact, please? I'll talk to them today. Because I'm planning to sell one and buy another one. So-
Okay, tell them I refer you, okay?
Oh, absolutely. And we split. I'm learning these things because no more paycheck for me. I left my W2 job. Anyways. So 2575. Okay, closing costs, 9,000?
Yeah.
About property tax on 700K, it's more like close 85, 88 per year.
Brentwood's a little lower.
It's all 1.25 approximately. What do you want me to put? 8,000?
Yeah, they.
Okay, 8,000.
Property tax fixed?
Huh?
No, oh, okay.
Okay, insurance. Rental property insurance is usually higher than your primary. So maybe 1,500.
Mhm.
Okay. There is an HOA fee, right?
I do not think that you have it, right?
Okay. Okay, no HOA, maintenance,
That's cool.
it has pool. Yeah,
5,000.
100 a day?
Oh, we're talking about annual, right?
Yeah, annual,
No. With the
Two.
pool,
with a pool. Let's say 200 a month,
yeah, so.
25.
25, okay.
2,500, assuming no other costs. What do you think would be the rent? Now, here are two resources I use to calculate the rent. And again, this is not, it's not like, I mean, they give you a range,
Right.
the rentometer. You can use the free version allows you like up to 5. I have a pro version, but I'm not on my laptop. Pro version, excuse me, it charges you like $70 or $80 a year, and you can analyze a lot of them. You can also, okay, so 3-bed, 2-bath. Oh, it's not allowing me. Sign up. Okay, I'm gonna sign up. I don't know whose laptop this is. I mean, I'm gonna sign in. I hope I remember rentometer, yeah. Okay, this one didn't work.
So no manual rent.
Now you can, but this is a quick and dirty. These are pretty accurate though,
Okay.
pretty accurate. The Zillow one, which is free, I've found it lately even more accurate. But let's compare both of them. Okay, so here it is, rentometer. It says average is 3,000 something, 75th percentile is 31 something. I think it's low. It should be like between 30 to 34,
Yeah.
right? In my opinion, because I know that market a little bit. Now, I don't want to waste one report of mine, but you can actually click view pro report. It'll show you the rentals in that market that were recently rented and which are currently on market. And it'll give you with the address so you can compare.
I have a
One-
question. As an investor,
Yes,
to invest in a property with swimming pool or no?
no. If I get swimming pool, I close it. It's a liability.
Okay.
Yeah. I even take out the,
Jacuzzi.
yeah, jacuzzi, yeah.
I think it depends on what you're doing, because if you're doing like a Airbnb, something in Palm
No.
Springs.
Yeah.
You want to pull.
Sorry. Yeah, very good point.
That's true.
I only do, yeah, I only do long-term rentals. Yeah,
So long-term, yeah,
right. Yeah.
if you get to think about the area and the mix.
As in like your single family, if every month you make $3,000 to rent, so do you need to pay the tax? How much you pay tax?
Tax is based on your purchase price. So I'm going back to the rental property calculator.
The income.
No, she mean the income.
Income goes back to your.
Yeah. No. Okay, so first of all, if you are cash flowing negative, there is no income. So let's say rent is 3,000, your mortgage is 2,500, and your property tax is $1,000, and your insurance is $200. So that's like 3,700. So you already have a 700 negative cash flow.
Also, your cash flow calculates for the mortgage too, so it doesn't.
Mortgage is the biggest expense.
Okay.
Yeah, we are going back to that calculator. Let me wrap it up. I wanted to wrap up by 7, but okay, so there's another one, Zillow. I have to sign in on this one too. Oh my God. This one I've found a little more accurate lately. Maybe Rentometer is not getting enough revenue. Okay, so these are pretty close. So this one says it's at 3,000. So maybe it's 3,000, 3,100. Let's say our property comes with a pool, so we'll go with 3,100 or maybe 3,200. So what do you guys want to go with? 31, 32?
32.
32, okay. Sarah is optimistic. No other income. Let's say vacancy rate 5%, which is, let's say 1 month in every 2 years, the house will be vacant. Tenant moves out, another tenant comes in. Management fee, let's say 6%. Value appreciation, 3% is conservative. Let's keep it at that. We are holding it for 20 years. Cost to sell, whenever we decide to sell, is 8%. $1,500 negative cash flow. Congratulations. Yeah, 1449 negative cash flow.
So no need a pre-tax?
No,
No.
you should be getting something there. She's buying tonight. Can I help you put?
Do you wanna, can you afford that much negative?
Exactly.
So basically, it's hard to find in the Bay Area.
In the Bay, this is almost 1 hour. This is almost 1 hour outside Bay Area.
Much is that.
And that's why I am not investing in single families anymore. I'm going for small multi-families because for the similar price range, they give much better rent. However, they do not appreciate at the pace of single family, but my tolerance is not 1,500 negative cash flow per property
This negative cash flow for 1 year or how?
per month. This is per month.
So that's what you
This is
decide
for
what your strategy
I-
is. That's why that's a,
Are you
where cap rate is better in the Midwest.
17,000 per year?
Holding the house appreciation.
Okay. Let's take a look at the brighter side of it, glass half full. Your cap rate is 3.1%. Cash on cash is almost 300. Internal rate of return 5%, and this is the profit when you sell it. We can go into detail about what these terms mean, but basically, cap rate is your the percentage at which your investment is the percent you are getting back year over year. Internal rate of return is how much your money is appreciating by, which is about 6%. Profit when sold, this looks like a pretty good number, right? But this is over 20 years. If you hold out for 20 years, I bet if you follow the right strategies, you will make much more because the moment it appreciates 30-40%, take a cash out refinance, put that money elsewhere. Another 30-40% cash out refinance, put it somewhere else. So you will earn much more. But this is not a good investment with 25% down. So that's why people who are investing in single families these days, they are doing like 40-50% down. No matter how wealthy a person is, like $2,000, $3,000 negative cash flow per month hurts.
I have a question.
Yes.
So this was a single family home, but if you want to invest in multi-family unit in Bay Area, would that be more?
That would also be difficult because when you talk about multifamily in Bay Area, you're starting at 1.5 million or something. Yeah, it's just Bay Area is so expensive. The rents have not caught up with the home prices.
Yes.
Maybe we don't see you in Sacramento.
Anytime, anytime.
I
Yeah.
have a really question, because if in my area, you're never gonna get cash flow, it's always negative cash flow. But the thing when they buy and invest and rent it out is because of the appreciation.
Yes, Bay Area is all appreciation
So
play.
that's why this formula, I'm not sure why you say it, I'm not saying that it's bad or not bad to buy, to rent it out, but what I mean is there should be a formula, like which number consider good, in which number consider not good, in terms of appreciation.
This is appreciation, right
Right.
here. This is appreciation.
But this is only 1 year.
This is, this is 20 years.
Year.
You
okay.
can, if you can make $500,000 in 1 year, take my money.
When you sold, you will pay tax.
It's same everyone. Yes, everybody. pays the tax.
Oh, okay.
You pay the tax on, you pay the tax when you sell it.
Don't matter.
Yeah, so on cash flow, guys, seriously, you pretty much would never pay cash, you never pay tax because your standard depreciation,
Right.
that is over 27.5 years, will almost always offset your cash flow. So even if you are cash flowing handsomely on a property, that standard depreciation is gonna be pretty much always more than that.
And that's why it's important to partner with CPAs so
Yeah.
that they understand all the strategies.
Right,
Right, because if you're looking at like something so micro.
Yeah.
That you'll never get over that hurdle of investing yourself or at helping educate
exactly.
other investors, right? And
Yeah.
so,
Again, this is the reason I'm showing this. You can have those conversations with your investor clients.
it
What-
depends on what their goals, and it goes back to what Deepak was saying, their
Right.
goals and their needs and what their threshold of risk.
Yeah.
Right, because you can take 1.5 million and buy a 20 unit in Alabama and probably generate 30K in rent every month.
And 2% appreciation in the next
But
15
it's
years.
it's a lot lower appreciation.
Yeah.
So it's like diversification. You want to have
Right.
some things that have good passive income, because if you're taking all that passive income and dumping it towards the principal
Yeah.
of that loan, it pays it off faster, then you can do what? You can borrow against, have leverage and do it again. So that's one strategy, you know, and then you have the one where you can max it out, so maybe you break even
Yeah.
because you're banking, then in 5 years in California, it's gonna appreciate, you can sell it, and then you have that money. So they're totally
Yeah.
two different strategies.
Exactly.
Some people like to do both. Some people like to be near their rentals and drive by. I don't wanna do that. I don't wanna see it. I pay a property manager. It's out of state, like, I don't care. I'm never gonna go there.
Yeah.
Right? And
Yeah.
so you're just constantly, so we're not using that passive income. We're just constantly taking it and put it to the principal.
Yep.
And just replaying it. And then, but you can buy more little $100,000 rentals.
Right,
So
right.
It's just,
Yeah,
it's just kind of
Yeah.
really,
every investor,
there's so many different strategies and approaches.
Yeah.
That's where you have to kind of educate yourself.
yes, so many different strategies and everyone has their different goals. The more you read about it, the more knowledge you gain. Yes.
Before the buyer would like to buy this investment property for the first time, would a vacation home be anything similar or comparable to that? Because you can claim half of, time you have to stay there or use it, and the rest you can just Airbnb it or somebody manage.
I think there's a restriction on how much you can rent a vacation home, because if you're renting it too much, then it becomes an investment home. It doesn't qualify as a vacation anymore. I do not know, because I don't consider myself at that stage in life where I can afford vacation homes. So I only buy investments.
Also, I don't think you can do 1031 exchange on vacation homes.
Vacation home is again luxury. Yeah. So, but the only advantage I see it, you get the primary home interest rate when buying a vacation home, because it's considered secondary home, right? Yeah.
It changed.
Oh, it changed too? Okay,
The vacation homes rates are higher than primary.
okay, so don't go vacation as well. When did you buy it?
2016?
Exactly. He's saying it changed now.
Huh?
The rules have changed now.
Oh.
Yeah. Right. So, okay, one more thing I wanted to show you, guys. Let's say on this, the mortgage. Okay, let's take the numbers of this one. This one we did 719 with a 25% down. It's okay. Okay, the brighter side of it. Yes, the cash flow is $1,500 negative, but it's not your loss per month. Your loss is much less. Why? You took a loan of 75% of 719. So 719, 900, 75% is 53,000. No, sorry. What did I do?
Wait, that's the loan.
Yeah, 539,925. I want to show you loan amortization. The loan amount is this. Loan term, 30 years. Interest rate was 6.2.
Yeah.
Right. You're gonna hit calculate and see amortization schedule. If you can read, I don't know if we can. This is an expensive laptop. Mine can't do it. Okay. So this is the payment per month.
Mhm.
This is the interest. This is the principal. The principal is money back to you. It's reducing your loan liability. So this is what actually you are paying. So from that 1,500 negative cash flow, if you take this out, your loss is more like $1,000. Another point of discussion to have with your clients.
Okay.
Simple enough, right?
Yeah.
Every single month, your principal keeps increasing. You're putting $2 more or $3 more towards your principal and paying less interest. The more you hold the property, your contribution towards your principal keeps increasing, contribution towards interest keeps decreasing. So it gets, and your rent keeps going up year over year. So it keeps becoming sweeter and sweeter deal for you. So, sorry?
You can pay more towards your principal at any time.
You can pay more towards your principal at any time, but that would not change your mortgage payment. Yeah.
That's true.
Yeah. So in other words, if you can sustain the equation today, it's only gonna get better tomorrow. It won't get worse. Only situation it'll get worse is when you will do a cash out refinance. But you will do a cash out refinance to get more money in the bank. So I would any day take 50,000 in my bank account and pay $100 more to somebody.
Quick question on cash out refinance. So
Yeah.
you can only do with the purchase price that you get, not with your current home price.
You do it with your current home price. They do an appraisal. Otherwise, you can never do cash out refi.
Right, okay.
It's always with the current appraisal, current market value.
Got it.
Technically, the only like benefit of buying a house that's appreciating is like.
House
when you-
don't depreciate.
Oh, sorry, or you know how,
I mean, the land.
yeah, you know how there was some loss?
Yes,
The way to be able to make it a benefit is basically cashing out your equity.
Yes,
To be able to have more
equity, yeah.
investment.
always remember cash flow is to sustain. Equity or appreciation is to generate wealth. So if you can sustain with the cash flow, positive or negative today, you should go for it because equity is what's going to build you up. I personally look for a combination in the sense I at least want to break even. For me, break even is zero cash flow or like 100, 200, maybe 200, 300, not even $500 negative cash flow.
Is it
But
Buffalo the Bay Area?
no, not Bay Area. I'm investing in Sacramento these days.
Yeah.
But I invest in areas where I see good probability of future appreciation. And then again, you look at the neighborhood, you look at the history. Bye-bye. You look at, I mean, we are realtors. We can log into MLS, get all kinds of data. I mean, I can go on and on about this, but I look for a combination. I have helped buyers here who do not care about cash flow. They just want appreciation. I have one investor who bought with me in Berryessa last year. They bought a trust property and they did a complete remodel. They are cash flowing negative 2,500 month over month. That's 30,000 in a year. But the moment they renovated it and put it on market, they already have 150K of equity. Today, they should have 200K of equity. He's like, I want 400K of equity before that. Don't come and talk to me about selling this home. That's his game. He has priced 30,000 negative cash flow year over year, and he's okay with it because he's banking on future appreciation. That's his play. That's not my play. We both are investing.
Can do that play.
Exactly, right?
Not too many people can do.
Exactly. Two investors, two newbie investors, totally different strategies. And as of today, his approach also looks very right because he's already gained 200+ K of equity. I told you I can give you like take out 6 to 7% of the commissions, you could still net more than 100K on a property you bought less than a year back. He's like, get out, I'm not interested. I want to net at least 300K or more. So yeah, again, talk to your investors, ask open-ended questions, come up with the strategy, come up with the buy box, help them with these resources, and they would work with you.
People, which market would you recommend to start with as an investor? I mean,
Long-term hold. Again, depending on your risk tolerance, I really like Contra Costa these days. It's a very good market for starters like Brentwood, Oakley. These are good areas with good schools, but then we saw this negative cash flow, right? If you can find a multifamily there, might be even better. But if you want equations to be a little more in your favor, talk to me about the areas in Sacramento, because Sacramento Valley is huge. You want to be careful where you're investing. And I have the entire team there who could help you with pretty much everything. But yeah, duplex or over Sacramento, I think you can still break even, almost break even. Yeah. Any more questions?
Are there any other books?
Yes. So, okay, good point. Pretty much all investors that I hear the podcasts of or the YouTube videos, they say I started with Rich Dad, Poor Dad. For me, it was not the first book, it was my second book. I started with Brandon Turner, who's like the main guy in Bigger Pockets. It was his book, Investing with Little or No Money, something like that. Little or No Money of Yourself, something like that, by Brandon Turner, in which he talks about Rich Dad, Poor Dad so much. I was like,
I gotta read it then.
I gotta read it. I was just waiting for that to finish to start Rich Dad, Poor Dad. Rich Dad, Poor Dad is about awareness. It's all about awareness. He will not go over any particular area or number. It's a priceless book. It has been a bestseller for decades. I remember growing up in India. When I came to Delhi, I used to go to Connaught Place, is a very famous shopping area. It has everything. There would be these booksellers on the street side, and they would have Rich Dad, Poor Dad lying all over the place, like all over. And I just kept seeing it for years and years and years. And that was, I'm talking, I don't want to date myself. Okay. many years back. And it reached all the way to India that time, when we were even not this technologically advanced. So that shows you the power of the book. It's still selling like crazy everywhere. Read that book. You can actually listen to it. There's nothing to see in that book really, but just the way Robert Kiyosaki explains everything, so simple. And I love when people explain complex things in a simple way. That should be everyone's mantra in life.
Would you invest in like the valley?
Which valley?
Let's say those Banos or.
Yes, I will. It's the same thing, like going up or going down. It's pretty much the same thing right now. I tell people Bay Area, that concentric circle called Bay Area keeps expanding every year.
Right.
15 years back, we used to say, oh, you live in Fremont, that's close to Bay Area. Today we say, oh, you're in Danville, you live in Bay Area.
Yeah.
So different, right? So means of transport keeps getting better. Few years down the line, Sacramento, you're lucky to be living in Bay Area. It's coming. That's why I'm investing there. Huh? Right? Okay, so the first book I told, One Rental at a Time, that guy made a fortune just investing in Fresno. But he was investing when it was 250. Now it's more like 550. Oh yeah, sorry, these are for you. I get my sugar for the day with boba. Any other questions?
Especially there's a train coming from Bay Area to Fresno, right?
Yeah.
Thing that would help.
Yeah, I mean, the project started and stopped and then started again. It'll take a few years, but overall, I think long-term, we will get faster mode of transportation. We have to. The moment we get that, all these prices of these areas start going up.
Did you say from here to Fresno?
Yeah, the bullet train project. Yeah, but it started, it stopped, then it started. They estimated
1 hour.
Yeah.
Yeah.
To LA also, isn't it? To LA, to Los Angeles also, isn't it?
Maybe.
Our
But for that, but Fresno is definitely,
Elon Musk anyways is coming up with Hyperloop, right?
yeah.
God knows where, when and where he's going to set up that Hyperloop. But the moment he sets up a Hyperloop, those areas
Yeah.
just shoot up.
Yeah.
I think first one's going to be somewhere from LA, this way or that way, maybe LA to Vegas, I think
That's right.
could be the first one, right? So buy in Vegas. Yeah, because you can, what's the point of buying in LA? Buy here rather, right? So the prices are so high there already. So rather buy in Vegas. But yeah, there's multiple strategies. No strategy is wrong as long as you hold long enough. And to hold long enough, you have to have the risk tolerance.
I have a question, this may be a silly one, but
No worries.
would it be smart to take equity on one, just move them, even at my age, what do you think, Michaela? I mean.
At any point, because that money is just sitting there doing nothing. So open a HELOC. If you don't want to, if you want to keep your current mortgage interest rate, open a HELOC. And then if you're using that HELOC, make sure you're justifying it, because HELOC in today's time is more like 8 to 8.5%. Yeah.
It's gotta be the math.
Yeah. Yeah. So I opened it. I just don't have the courage to use it.
You also have to have reserves. It's not just about buying the house. You have to have money in reserve in case you don't have anybody renting, if the roof goes bad, you can get a permit, like. You just say about 20%.
Yeah. So we prepare for the worst, but expect the best.
Do you think invest in California or other states make any difference for you at this point?
I love California because what appreciates? Structure or land? Structure appreciates?
Land.
Yeah. Why would you get depreciation if the structure appreciates, right? It's the land that appreciates. What happens in Austin? Let's say in Austin, they take a lot, they cut it into parcels, they build homes, they all get sold out. What happens? They take the next lot and cut it into parcels. Here, where is the lot? We don't have any land left here. So that's why I invest in California. Our land is the most scarce resource.
Is Austin growing the fastest in the country?
Yes, because they have lots of land. But I believe California, NorCal will continue to appreciate, just because we talk about exodus. We do not talk about the influx, because we are used to it for the last 25, 30 years. It just keeps happening. It's not a news. People leaving California is a news. So we talk about it, and then people coming into Texas, people coming into Arizona, people coming into Tennessee. This is big news. This was not happening before. For California, it's our everyday life, right? But that doesn't mean people stopped coming here. People are still coming. Why? I mean, do we see all these skyscrapers building all around us? They've taken away all the single-story business parks. They have built apartments and condos all around us, right? That's why, because people keep coming here. Not everybody can afford to buy a home, so people rent, and there is demand. Why is Fremont downtown now an opportunity zone, right? Somebody is building something there. Go take a look at that. Yeah, people are still the houses pretty much get rented overnight in Bay Area, pretty much overnight, because there's so much demand. That's why I want to buy. Ideally, I want to buy in Bay Area, but I cannot afford neither the down payment nor the negative cash flow. So I start going out in concentric circles. I spent months analyzing Hayward. It was still cash flowing negative $500, $600, $700 for me. I'm talking 2019. Even then it was cash flowing negative. So I ended up investing in Antioch. By the time I was ready to invest in Antioch again, prices shot up so much, I went further out. I could go down south the same way. People who invested in Los Baños and what's the next city? Hollister. They went up in value the same way, right? Yeah, because as Gilroy became expensive, people started going further below. It's the same thing, circles. Yeah, I mean, these sides you cannot go because there's water. You can go this way.
Still in those areas, still 100,000 minimum, perhaps
100,000 minimum investment.
investment.
Yeah, because 100,000, you're looking at a 400K home. Yeah, you don't want to buy in a war zone. So buy in a decent neighborhood so that you're not up there every day yourself.
100,000 and update it and then rent it out.
Yeah,
Refi.
yeah. Refi again. Real estate is a get rich slow scheme than a get rich quick. But as long as you can sustain the numbers today, go for it.
How about flipping in the area? Still works in Bay Area?
Yeah, flipping is what like talk to this guy, Sean.
Inventory.
He's
super low.
Sean, he breaks his own record every year.
Yeah.
He's a flipper. He has a team, like son and dad, I think. They both are flippers. Yeah, he's like at the top. He's doing the maximum business in our office, I think. Yeah, so yeah, flipping is big business in Bay Area. I know many people who are into flipping. But yeah, flipping is a very involved job. In my opinion, it's almost like a full-time job. I want to do it someday, but just not ready yet. And again, you have to have a much higher risk tolerance.
But you know, everybody in business.
No, it's different. It's different, right? Yeah, it's different. Yeah, you need to have different kind of team. You also need to partner with hard money private lenders. And ideally, I want to do it along with somebody, because if, let's say we have a 3-month project, we're trying to sell it within 3 months. What if the market changes in 3 months? So we need to mitigate the risk amongst ourselves. So, yeah.
You know, how many investment properties you need to have in order to be like a professional, real estate professional?
No, it's not about investment properties. You could have none, but you could, yeah, you need to talk to the CPA, but you need to document and prove that you are putting at least 750 hours per year towards real estate investment. And that's at least half of all the work you do. Well, if you keep claiming real estate professional and you don't even own a single investment property, then it shows that you are trying to, right, bluff. But there is no such rule that how many investment properties you have to have. Show the efforts, document them, document your trips, document your expenses, document your meetings with contractors, lenders, whoever. Yeah. There are real estate professionals, they expense all kinds of stuff. They expense their own personal vacational trips. They would go do a meetup there and expense their entire trip. Advanced level stuff. We're still recording, sorry. No. But that comes at a much later stage.
Do you think it's good to start an investment group to start this project?
Flipping?
No, rental.
You can do that. You can form a you can form a corporation. Syndication is different. That's for multifamily. You can form a corporation and do it with people. Okay, this is $5,000 advice.
It gets very complicated.
You need to have a,
Business structures and.
you want to make sure if you, yeah, buying investment property with partners, have a buy and sell agreement that covers all life situations. Topic for some other time. That's a lot of information, right? Yeah.
What the benefit is they can keep on buying within, you can keep on buying within.
Yeah, you leverage. Yeah, leverage. Yeah, sometimes you see bright prospects for a house for appreciation, but you just can't afford yourself. That's the time to bring in partners, people you trust. Okay. Anything else?
Everyone take a cupcake.
Yes, everyone take a cupcake, please. Thank you so much.
Thank you. Yeah,
No worries.
really.
You're welcome.